Hey guys, welcome back. James here. Today I want to discuss a little bit about inflation and the value of money. So everybody's heard the news over the last 12 months plus, probably 2 to 3 years now. Everybody's got their eyes glued to the Reserve Bank of Australia each and every month, waiting for what they're going to tell us about the interest rates, whether they're going up, whether they're going down, whether they're stabilizing. And so I thought I'd just do a little short video on inflation and the value of money, just so people understand the source of inflation and how it actually occurs. Now, before I get into that, I want to touch on inflation just briefly and explain what inflation is. Now, for those of you who don't know, inflation is defined as the consistent increase of prices for goods and services in a market. That's technically true, but inflation is actually a symptom. So the real cause of inflation is by having excess money in the financial system. Now, how does that occur? Money is printed by the Reserve Bank of Australia. So at times when the government requests for the Reserve Bank of Australia to print more money than we actually need in the economy, we have inflation. Conversely, if there is a point where there isn't enough money in the economy, we face a scenario called deflation, where prices actually go down. Now, it's not actually that the prices are going down, but it's the value of the money that is going up. And the value of the money is going up because there's less of it in circulation. So back to what I was talking about. During COVID, which most of us are familiar with anyway now, there was an excess of money being printed into the financial system by the Reserve Bank of Australia. And while I don't think it was purposeful that the government intended to flood the country, in fact, most countries around the world flooded their nations with excess money, they did it out of what they deemed necessity. So what that has actually done and the impact that that has actually caused on our economy is that too much liquidity or money in the system means that there's more money to buy products, to purchase products. So the value of those products actually goes down. So during COVID, when all this excess money was printed and injected into the economy, corporations saw the opportunity, which happens in every economy, and it's just natural economics. Corporations saw the opportunity to increase the prices of their products. Now, the value of the product didn't increase, but it was the price that they were demanding, and they were demanding the price increase because they knew there was more money in people's pockets, essentially. Now, there's two sources of inflation in the economy. There's supply inflation and there's demand inflation. Demand inflation occurs when the money supply is increased. Now, when the money supply is increased, there's more people vying for the same amount of goods. So the amount of goods stays stagnant, but the amount of demand for those goods increases. So what happens then is the price of those products increase. And what that does is take a certain percentage of buyers or consumers out of that particular market. On the supply side, supply demand is known as demand where a corporation cannot get their product or service to the market to fulfill the demand for that product or service. So because there is less of that thing, consumers are willing to pay more, and that again reduces the amount of consumers in that marketplace. Now, COVID was a perfect storm because on one side, we had excess money in the system, right? So everybody had money in their back pockets ready to spend. We also had real issues with our logistics. Our global shipping was being impacted constantly. We were seeing manufacturing, China being a great example of manufacturing being reduced to a fraction of its output capacity. And so we had this perfect storm. We had excess money in the system and we had a lack of products and services for consumers to buy. Now, as we've seen, that caused both of those two things on their own cause inflation to take off. Both of those things combined, well, we've seen the result of that. And that's what we're fighting now. All right, so I hear what you're saying. Cool, James, I understand inflation, I get it now, but what does the interest rate have to do with that? So the Reserve Bank of Australia are the only ones who can also control the level of inflation in the economy. So you might be thinking that the Reserve Bank have a plethora of tools, have all these tools at their disposal that they can use to reduce inflation. Well, they don't. So the only tool they actually have is the cash rate. When we talk about inflation in the news, we talk about the interest rate. But what the Reserve Bank of Australia is actually doing is controlling the cash rate. Now, there is a difference. The Reserve Bank of Australia sets the cash rate, which is the rate at which money costs. Because the Reserve Bank of Australia is the only organisation that's allowed to actually print money, all the commercial banks and the government all go to the Reserve Bank to get their money, to get their loans. So they're the only source of loan to commercial sized banks and the government. So the cash rate is the rate that the Reserve Bank sets the cost of money for those big corporations, the banks, the governments, etc., to borrow money off. Now, where the interest rate comes into play is when banks borrow that money from the Reserve Bank of Australia and then have to loan it out to John and Jane Smith to purchase their new home by way of a mortgage. Now, they actually have to increase another percentage on top of that cost for them to make the money. And that's why we discuss this in terms of interest rates and not of cash rate, because the interest rate affects mums and dads, the ones who watch the news every night, the ones who have to work 9 to 5, week in, week out to get the money to pay their mortgage. It's all expressed in interest rate, which is it's the bank's essential control the value of money, i.e. inflation. The Reserve Bank will continue to increase the cash rate, which essentially makes the cost of money more expensive. In the same way that John and Jane Smith won't pursue a home loan from the bank because the interest rates are too high and it's not really worth it. In that very same way, corporations won't pursue loans from the Reserve Bank of Australia because the money that they're going to have to make back on that borrowed money just to pay back the cash rate plus profit for them is just really not worth it. So what the RBA is trying to achieve essentially is cooling down the market by slowing to a controlled point where people do not want to borrow money anymore. Now, when you get to that point when people aren't borrowing anymore or borrowing much less, they're investing much less. What does that mean? It means the stock markets don't continue to go up and up and up. It means housing prices don't continue to go up and up and up. And so over time, not quickly, but over time, as we're seeing, 6, 12, 18, 24 months, the opportunity for investing starts to leave the market. And in this way, inflation starts to reduce. Now, as we discussed about earlier, inflation is when there's excess money in the system. Now, if people aren't spending money, if people aren't buying investments, if people aren't buying houses and cars and clothes and all the rest of it, if they're saving their money, then that's when asset prices start to fall. That's when home prices start to fall. And we've just seen this recently with Sydney's first month-on-month drop in house prices, in the median house price since 2023. I believe it was January. So we are starting to see slowly, but surely we are seeing real signs of the economy slowing. And so that's inflation in a nutshell, which is sourced from the actual value of money. So if you take away anything from this video, I want you to understand that although inflation may be seen by the consumer as prices going up and services going up, what it actually is it's the value of your money going down. And why is it going down? Because there's too much of it in circulation. Hey guys, if there's anything you want me to add, or you have any further questions about this video, please leave a comment. See you in the next video, guys. I hope you enjoy this.